Welcome back to the Daily Crypto Deep Dive. When people look at Bitcoin's price action right now, most of the attention is still focused on the obvious things. ETFs, inflation data, interest rates, short squeezes, headlines that dominate the timeline for a few hours, and then disappear. And while all of that does matter in the short term, it's not the most important thing happening underneath the surface of this market. The most important thing happening right now is a slow-moving supply shock, one that almost nobody is talking about properly. And it's being driven by corporate balance sheets, not traders. Today we're going to break down why that matters, what the numbers actually look like, and why this might end up being one of the most decisive forces shaping Bitcoin's price over the next few years. Because once you really understand this, you stop reacting to every dip, every wick, every red candle, and you start looking at the market very differently. Let's start with the single statistic that should stop you in your tracks. Over the last 6 months, public and private companies have collectively bought around 260,000 Bitcoin. Over that exact same period, Bitcoin miners produced roughly 82,000 new Bitcoin. That means corporate buyers alone absorbed more than 3 times the entire new supply. Not retail, not traders, but companies. And that changes everything. To understand why this matters so much, we need to step back and remind ourselves how Bitcoin supply actually works, because a lot of people talk about it, but very few truly internalize it. Bitcoin has a fixed issuance schedule. Roughly every 10 minutes, new Bitcoin is created as a reward for miners who secure the network. That reward halves every 4 years, and right now, after the most recent halving, the amount of new Bitcoin entering circulation each day is already historically low. Bitcoin's supply does not respond to demand. It doesn't ramp up when price goes higher. There's no central authority that can issue more units to meet market needs. So when demand increases, especially sustained demand, the only thing that can adjust is price. For years, the main buyers in the Bitcoin market were retail investors, traders, hedge funds, and a handful of early adopting institutions. Those groups behave in fairly predictable ways. They buy when momentum looks good, they sell when fear spikes, and they tend to be price sensitive. Corporate buyers are different. When a company adds Bitcoin to its balance sheet, it's not thinking in terms of daily candles. It's thinking in quarters, years, sometimes decades. That Bitcoin is not sitting on an exchange waiting to be flipped. It's locked away, often custodied with institutional providers, and treated as a strategic asset. That's why this shift matters so much. The most obvious example is MicroStrategy. At this point, MicroStrategy holds close to 687,000 Bitcoin, representing roughly 60% of all Bitcoin held by publicly listed companies. But here's the mistake many people make. They assume MicroStrategy is the whole story. It isn't. What's happening now is that MicroStrategy is no longer an outlier. It's becoming a template. Other public companies, private firms, family offices, and corporate treasuries are increasingly viewing Bitcoin not as a speculative asset, but as a strategic reserve asset that sits alongside cash, bonds, and equities. And once a company makes that mental shift, the way it interacts with Bitcoin changes permanently. These companies aren't trading Bitcoin, they're accumulating it. Now think carefully about what that means for supply. Bitcoin miners are the only source of new supply. Every day, a fixed number of new coins enter circulation. If miners sell all of them, the market absorbs that supply and price stays stable. If miners sell less, price rises. If demand exceeds supply, price rises more aggressively. But miners are no longer the dominant sellers. Instead, miners are competing with corporate buyers who are willing to absorb not only all newly mined Bitcoin, but also a significant portion of existing circulating supply. That's where the supply shock comes in. When companies buy Bitcoin and move it into long-term custody, that Bitcoin effectively becomes illiquid. It's not gone forever, but it's removed from active trading supply. And when enough Bitcoin is removed from circulation, even small increases in demand can have outsized effects on price. This is why price action can suddenly feel explosive after long periods of consolidation. Now layer on top of this what's happening with ETFs. ETFs have opened the door for a completely new class of buyers. Pension funds, registered investment advisors, asset managers who couldn't previously touch Bitcoin directly. When these ETFs see inflows, They have to buy actual Bitcoin, which is then held in custody, not traded. So now you have two major forces removing Bitcoin from circulation at the same time: corporate treasuries and ETF custodians. Neither are sensitive to short-term volatility. Neither panic sell on red days. Neither day trade. That's why today's market feels structurally different from previous cycles. In past bull markets, demand was overwhelmingly speculative. When price went up, leverage increased. When price went down, leverage unwound violently. What we're seeing now is closer to a slow squeeze. Not a short squeeze, but a supply squeeze. And those are far more powerful. One of the clearest signs of this shift is what's happening in derivatives markets. For the first time, Bitcoin options open interest has overtaken futures open interest. Institutions don't use options to gamble. They use them to manage risk, protect downside, and structure exposure. And who dominates this options market? BlackRock. BlackRock's Bitcoin ETF now accounts for more than half of all Bitcoin options open interest. That alone should tell you something. This isn't a retail mania. This isn't meme-driven speculation. This is institutional capital embedding Bitcoin into portfolio construction. Let's talk about time horizons, because this is critical. Retail investors think in weeks or months. Traders think in days or hours. Corporations think in years. When a company allocates part of its treasury to Bitcoin, it's making a long-term statement about monetary policy, currency debasement, and asset preservation. That Bitcoin is not there to be sold at the first sign of volatility. It's there as a hedge. That means fewer natural sellers. And that's the part most people miss. Markets don't move up because there are buyers. Markets move up because sellers disappear. When sellers stop selling, price rises until someone is willing to sell again. Right now, miners are selling less. Corporate holders are not selling. ETF custodians are net buyers. Long-term holders continue to accumulate. So where does supply come from? Short-term traders. And when price rises quickly, those traders get squeezed out, which is exactly what we saw with nearly $600 million in short liquidations. That wasn't the cause of the rally. That was the consequence of a deeper imbalance. Analysts are starting to acknowledge this openly. Bitwise's CIO recently pointed out that since spot ETFs launched, they've absorbed more than 100% of all newly mined Bitcoin. Even if miners sold everything they produced, it wouldn't be enough to meet ETF demand alone. Add corporate treasuries on top of that, and the picture becomes very clear. This is why some analysts believe Bitcoin's traditional cycle behavior may be changing, not disappearing, but smoothing out. Instead of violent boom and bust cycles, we may see longer accumulation phases followed by powerful repricing events. Does this mean Bitcoin only goes up from here? No. Volatility is part of the asset. Corrections will happen. But it does mean that every dip is now competing against a shrinking pool of available supply. And that changes psychology. Dips get bought faster. Fear resolves quicker. Floors keep rising. That's not hype. That's structure. The final question is always the same. What happens if companies decide to sell? The reality is they won't. Not suddenly, not emotionally, and not in the way traders imagine. Corporate Bitcoin holders aren't leveraged. They aren't margin called. They don't panic. If they sell, it will be gradual, strategic, and tied to balance sheet decisions, not fear. More importantly, once Bitcoin becomes part of a company's public identity, selling it during volatility becomes reputationally difficult. Selling undermines the narrative that justified buying it in the first place. So when you zoom out, the story becomes very simple. Bitcoin is being absorbed into balance sheets that don't sell easily. Supply is being locked away faster than it's being created. And when supply disappears, markets reprice. Slowly, at first. Then suddenly. That is the corporate Bitcoin supply shock nobody is talking about. And once you see it, you can't unsee it. If you found this useful, drop your thoughts in the comments. As always, thanks for listening, and as always, we will see you at the top.